Okay, so good morning, everyone. Welcome to the Macro Snapshot. What are we? Wednesday, November the 26th, 2025. Recording this in the morning, as always. What I want to have a look at is just quickly a review quickly of yesterday's data. We had quite a sort of a risk-on day yesterday in terms of the equities had a positive day. Of course, yields were down. There was some positive news coming out of Ukraine. And one of those one of the catalysts for that was this sort of idea of sort of bad news or relatively soft data is actually good news because it means the Fed will cut and that will support asset prices. And in fact, if we have a quick look here at the retail sales, now again, this is quite old data. You're talking sort of September kind of numbers here, but in general, you can see the month-over-month number for retail sales was on a downward trend. You see what we had released yesterday, but overall, it's been a downward trend. If you look at the core numbers, so excluding automobiles or cars, you can see that it was also soft. The control group, which was like the sort of the super core group, that was actually negative, and again, definitely softer than the last few months. So overall, it is looking as though retail sales overall are trending down, although it's not by every kind, as I say here, every kind of business. I mean, some stores are doing quite well. You've got health services doing quite well, furniture, home furniture, not too bad. So really, the big drop yesterday was things like sort of goods, sort of sporting goods, clothing, electronics was down. So it's a mixed bag, but overall, it does look as though it's relatively soft without being sort of disastrous. The other thing to look at here, yesterday we had the PPI numbers. Again, this is quite old data. It's, going back a couple of months or so. But generally it was, relatively, not bad in the sense that the core number was actually sort of down to 2.57, headline 2.72. So that's probably acceptable to the Fed. And if you have a look here, you can see here that the core goods here actually, basically came down quite a lot. So overall, not too bad. And again, not at 2%, but not really sort of ripping higher on sort of tariff worries about 3%. So all of that essentially meant that the yields were down overall on the day. If we go to, can I go to here? Sorry, just trying to find this. Yep. So if we go to, actually, I just want to show you something. So that was that. Now today, if we look at the data as well. So overall, as I say, it's sort of feeding into this narrative that the Fed actually will cut. And if you actually look at probabilities now for the December meeting, we're up to like sort of 85% suddenly of the Fed cutting. So if they don't cut, that would now be quite a big surprise. So what we have today in the US, keep in mind, of course, tomorrow's Thanksgiving. So probably the afternoon session today will sort of start to peter out and slow down. Tomorrow, the cash markets are closed, so the futures will be open for a few hours. And then Friday is probably going to be a soft day. And just in general, I do remember from sort of experience that often on Thanksgiving Day for the futures markets, low liquidity, I've seen some crazy moves in things like oil and gold. So it'll be an interesting one to keep an eye out for. But in terms of the data coming up in an hour or so, we do have initial jobless claims expected to come in around about 225,000, which again is very acceptable and is quite resilient market. So we'll keep an eye on that. Also, the continuing claims. Keep an eye on the fact that the idea seems to be that the jobless claims are not horrendously spiking, but on the other hand, continuous claims are ticking upwards, which would seem to indicate that employers are not doing mass firings at this point, although that seems to be going up. But really, the problem is trying to get a new job. So the continuous claims, it's taking longer for people to get a new job. So let's keep an eye on the initial jobless claims. We also have the Chicago PMI. That's for November, so that's an interesting survey coming up at 9:45. And we have durable goods, which again is a little bit old. It's from September, but let's just have a look at that and see if the consensus, which is for a slightly softer number compared to last month or the last data we had, is going to hold up. So it's going to get a bit of a data dump, and all of this is incrementally leading into a sense that the economy is okay, but slowly sort of weakening as so the job market comes under more and more pressure, and especially people in the so-called lower part of the K-shaped economy are coming under extra pressure. But the main thing which might be interesting in terms of the economic data is actually we have the Fed Beige Book. Where is it? So we have the Fed Beige Book being released at 2 p.m. And keep in mind that the Fed does look at that. Powell has told us he looks at that a lot, and that looks at all of the different districts of the Federal Reserve System and gives a lot of sort of anecdotal evidence, commentary on the job situation, confidence, and business sentiment. So that's quite important just to get maybe a slightly more up-to-date sense of sort of all across the US where the real economy is, and that will all feed into where the yields go and potentially expectations for sort of the Fed in December. But what's going to be interesting is going to be to see how long this sort of softening economy is actually good news, and because it increases the chance of the Fed sort of cutting. At a certain point, of course, this does generally sort of start to flip, that if the economy really does start to roll over, the bad news actually becomes bad news, and we could see equities under a little bit of pressure. So let's just look at a couple of charts here and just have a look and see what's going on. If we look at the equities, which I do believe is here. So let's just put this onto the daily chart and look at the equities. So you see here that the VIX also volatility it tumbled yesterday. It had been in the 20s. It's still not at its lowest levels. It's at 18 and a half here, the VIX. So it's definitely not in sort of super low levels like at 13, 14 or something like that. But yesterday it was in the 20s, and the daily VIX yesterday, I was looking at the ES futures, for example, at around about 8 o'clock. That was in the mid 20s, 25, 28, 29. So volatility was quite elevated yesterday overall, but that did come down during the day. And of course, that's always going to be a headwind, sort of a tailwind rather, for the equities. And you can see here, just ignore those purple lines just for the moment. They're something else. But basically, you can see yesterday, actually, I'll get rid of those just to clear this up. Please give me a second. Right. So you can see that yesterday we had quite a big, quite a nice sort of bounce on the equities. And that again was on the sense that, maybe the data is not great, but, it could be that the Fed is going to be cutting. And talking about the Fed, there are a lot of sort of substantial rumors going around yesterday, which got the market's attention, that the one of Trump's sort of cabinet ministers, Kevin Hassett, is definitely the sort of the front runner for the job of the Fed. That was sort of semi-denied, but maybe not strongly. And it's very interesting just to look at the preliminary market reaction to that. So when those Kevin Hassett rumors came out, I just want to look at the bond market here. So we've got the front end of the curve, the ZT, which of course is proxy for the 2-year, and you can see that in terms of the price here, went very, very strong to the upside and held that. It's subsequently come down a little bit overnight. So this is a snapshot from a late afternoon yesterday. But you can see that the front end of the curve really liked that. Basically on the idea that, Hassett was, very close to Trump. Presumably he'd be sort of cutting interest rates. So that's a positive for the front end of the curve. But it's also interesting to look at the back end of the curve. And here we have a proxy of the ZB, which is like the 15 to 20-year bond kind of proxy. And you can see here that when those rumors came out, opposed to the front end, you can see that, again, this is a 3-minute chart. You can see that it actually fell. You can see that the yield, the yield actually went up, but the price fell. So a very different reaction. Now, it did sort of recover, for the next hour or two, but by the mid-afternoon, it had actually gone, back to those levels, sort of quite negative. So what we're seeing here is that the market is essentially saying, hey, if Trump appoints someone who's close to him, who's considered less independent, who is going to be very, very dovish, maybe overly dovish, okay, sure, they'll cut interest rates. And you could argue that's good for the front end and eventually might be sort of a boost to the stock market. But that means they'll be maybe less focused on sticky inflation. That could boost the economy. We could be stuck with sticky inflation. And that's not great news for the long end of the bond curve, which, of course, does not like either of those things and would require high risk premium, a high sort of premium, so therefore higher yields. And that caused what we can see in the third slide here, which is a pretty aggressive steepening of the curve. Now you can call that a bear steepening or a bull steepening in the sense that it is bullish because the front end's going up, or bearish because the yields are less sort of supported on the back end. But basically the bottom line is that the front end yields are coming down harder than the back end yields, and you see sort of a steepening here. And the problem is that if you get too much of a steepening curve, that ultimately is not going to be great for sort of equities over the sort of the medium term. Maybe not in the first day or two or three, but the point is that a steepening curve does indicate sort of rising yields, especially for the longer term, like the 10-year and the 30-year, which does feed out into the real economy. And keep in mind that a lot of things like car loans and obviously mortgages are much more based on the 5, 10, 30 years rather than, let's say, the SOFR contracts or the 2-year yield. So that's a problem if the yield curves becomes too steep. Okay, so anyway, that's where we're at, and but let's keep a look for the beige book to see if that could give any more information about the economy today or whatnot. In terms of other stuff going on, as we're speaking here, just after 7:30, we have the budget in the UK being released. Actually, Chancellor of the Exchequer Reeves is actually before Parliament. But let's just look at a few other things. I just want to quickly review. We had the Reserve Bank of New Zealand, and as I was saying in yesterday's video, there was sort of a sense there could be a hawkish cut. And in fact, that's what actually happened. So if we look at the New Zealand dollar here on the spot versus the US, pretty strong reaction. As I say, that looks like it's going down. This is the 3 minute chart. You can see the reaction here was a very strong move to the upside. And that was, of course, yes, they did cut, they being the Reserve Bank of New Zealand, they did cut by 25 basis points. They're now down to 2.25. So they've cut actually very aggressively over the last, sort of period, 6, 12 months or so. But basically, if you look at the forward forecasts of the overnight cash rate, so the OCR, essentially that was not revised sort of lower, and that communicating to the market that in 2026 there probably wouldn't be forecast any more cuts. So essentially saying, hey guys, we're done. We've done with the cutting cycle, and also the Hawkesbury, the governor, essentially saying that inflation was, sort of reasonably okay. It's not too high. It's not too low. That they thought that the economy would pick up a little bit. So relatively upbeat in terms of the forecast for the economy going to 2026, and possibly more importantly, signaling to the market that this was sort of a one and done at this point, in the sense that this was the last cut for some sort of period, and the economy could be coming out of its lowest levels and starting to pick up. So that's a positive for the New Zealand dollar versus the US dollar. But also, if we look at the Aussie dollar versus New Zealand. So this is AUD versus NZ. You can see the Aussie dollar tumbling against the New Zealand dollar. And if you go on the daily charts, you can see here that, as I was saying, it had quite a lot of resistance at this level up here about the 115, but falling below there. So let's see if that continues to fall, or whether that maybe that's enough. But, quite good days for the New Zealand dollar last night. Okay, talking about some other stuff. Obviously, what's been in the news is the Ukraine. No deal yet. Obviously, there's a lot of toing and froing and a lot of these sticky points, but it does seem that Ukraine is prepared to sort of offer some compromises. US putting a lot of pressure on the Ukraine to, to do that. The Russians obviously maybe not doing as many compromises. So the point is, we're still some way away from that. But the fallout from that is interesting in terms of the FX space and commodities. In the FX space, we have something like Euro, Swiss franc, overall doing pretty well, quite solidly, sort of pushing up there. I mean, some of this other stuff from the US as well is affecting the dollar. So it's kind of a combination here that over the US we've had slightly weaker data, potential for a more dovish chair of the Fed. And that's pushing down the US dollar in terms of the interest rate differentials and whatnot. If you look at the dollar index, you can see that, basically over the last couple of days, it's sort of this sort of overhead resistance level here of just over 100, about 100 and a quarter or so. That seems to have been the resistance. It looks as though it's not going to complete this measured move at the time being. And in fact, it has, found this overhead resistance. So the US dollar under a bit of pressure. As I say, a bit of sort of positivity for Europe in terms of Ukraine. Also in the US, weaker data and a dovish Fed. It's sort of a double combo there, pushing down the dollar. And that's pushing up the euro overall. If we look at the euro, you can see the euro having a bit of strength, and particularly the euro having a bit of strength against the sort of safe haven within Switzerland, which we're looking at. And also with the Ukraine situation, as I say, something like Poland, one of these higher beta kind of European currencies sort of outperforming the euro itself. So interesting just to see what's going on there. Also, something to keep of note is what's happening with the Japanese yen. You can see here, although this does look like a bull flag, but the US dollar has had a little bit of weakness against the Japanese yen. That's possible. That's on the possibility of intervention. Quite a lot of verbal interventions happening. I don't think we've seen yet as like a real intervention. That could happen if the US data comes out weaker, because the Bank of Japan does like to push. But basically, one of the reasons for some of this, there were some rumors in the last sort of 24 hours that the Bank of Japan was maybe trying to sort of prepare the market for a potential interest rate hike either in December or more probably in January. So let's just see if there's any sort of tweaking of language, any little sort of leaks to the press about the Bank of Japan potentially, signaling to the market that they may be prepared to hike. On the other hand, this does still look as though the USD is in a sort of an uptrend here. It's going to be pretty critical levels here. If we bring this back to a 4-hour chart, just to break it down for a little bit more granularity here, is this actually some kind of sort of bull flag or so? It's going to be interesting to see if this breaks out because this is a sort of a bullish sort of flag or channel kind of situation here, and it does look as though it's breaking out. And if we actually look on a fib, let's just look at a fib. On the 4 hour, if you look at this most recent impulse from here, you can see that basically on the 50% retracement, US dollar was bought up. So in Japan, there is still quite a lot of concerns about the yields, these higher yields, and then the lack of fiscal responsibility, sort of deficit spending, a big stimulus package. Will the BOJ counterbalance that with a hike? Possibly, but it looks as though just at least in the last few hours, so the US dollar, they have, a few buyers have come in at this 50% fib. So it's going to be an interesting one. Also, very, very interesting, of course, is going to be the British pounds. As I say, as we speak, you see it's a bit choppy here. This on the 4 hour. Let's bring it back to a 3-minute chart. You see here a lot of choppiness. There was a leak by the Office of the Budget, which basically said that the fiscal headroom was going to be better, that the economy was doing better, and so that initially caused the pound to kind of rally. You see here it rallied at 6:30 our time, which was ahead of schedule because that was a leak. But now that not Governor, Chancellor of the Exchequer Reeves is delivering the budget, you can see it's quite choppy at the moment. So that's going to be a combination really of, I mean, what's going to move that? It's really going to be what kind of fiscal rules are going to be imposed, how much headroom, so how much fiscal space is there to stimulate the economy, or are they actually running out of headroom and fiscal space and have to be a bit more austere? What kind of tax are they going to put? There's rumors of higher taxation on, for example, dividend income on houses worth more than £2 million. So how much taxation is that going to cause an exodus of capital and of wealthy residents, and of course how much revenue? So it's quite a complex mix here, basically the bottom line is that the pound, in order for strength to come into the pound, it wants to see a reasonable amount of taxation without being too onerous. It wants to see fiscal rules being obeyed, and in general, it wants to see evidence that the government is not overspending and there's not a breakdown in fiscal discipline. So you see here the pound seems to be lacking it in the last few minutes. And if we actually just look, also going to be interesting to look at, let's say where is it? The UK 10-year yield, if that's the right symbol. Yeah, I actually just want to look at the 10-year yield. I always forget the symbol. We'll just look at the where's the yield? Anyway, doesn't really matter. Okay, so again, we're looking here. This is not the yield. This is the actual the bonds, the 10-year bond, and you can see that that's moving in concert with the pound. So that's an interesting dynamic for a developed market, but basically seems to be quite liking that, although it is still quite choppy. So we'll have to review all of that probably after the video once she gets through her speech, which normally goes for 30, 40 minutes or so. In terms of other stuff to keep an eye on, I just want to have a quick look at oil, just to finish off here. Also, gold is an interesting one, just because of the potentially the new Fed chair coming in a few months. So you see, oil continues to remain heavy. Again, as long as we continue to get these relatively positive developments coming out of Ukraine-Russia talks, oil is going to find that sort of problematic. So it looks as though oil, without sort of collapsing here, does want to drift down. But I would say, as I said, I do remember in the past on Thanksgiving morning when there's very low liquidity, or historically low liquidity. I have seen that. I remember there was a giant move in oil a few years ago of $10, so 1,000 ticks. And if the oil traders, just while the futures markets are still open on low liquidity, maybe tomorrow they did want to press there, it would not surprise me at all if we suddenly saw a move below this 55 3/4 level here, which would run all of these stops. You see this level here, and suddenly we could see ourselves on sort of Friday morning down at 52 or something. So it's going to be an interesting one to keep an eye out for. We had API last night, so the private inventories, that came in as a small draw, which is a little bit positive in theory for the oil market, but obviously not enough to stop this sort of grinding down. And this morning we have early we not early, but we have the official DOA, so Department of Energy numbers for oil in terms of the inventories. Again, I think that's really not going to move the market too much because the bigger picture just at the moment is the geopolitics. So let's really keep an eye on oil. That's that one there. And also, just finally, I want to have a quick look at the precious metal, specifically gold. Maybe I won't look at silver, but if we have a look at gold here, see starting to push up a little bit here. Some of these sort of fib retracement levels, it was in a sideways consolidation, but now starting to push up. And that, I think, if we go to a 3-minute chart, we can just see also the reaction yesterday in terms of what happened with the announcement of Hassett potentially becoming the new chair of the Fed. And you can see that it was a bit choppy, but overall gold kind of grinding a little bit higher because in an environment where the Fed is cutting and inflation is remaining sticky, that plus all the geopolitical stuff and de-dollarization and whatnot, this is a good environment for gold. So it would not surprise me at all to see gold renewing its medium-term trend towards the upside. Okay, guys, I'm going to leave it there. As I say, we have some data at 8:30. Let's look out for the beige book at 2 p.m. And by that point, the markets will probably be slowing down in order for the Thanksgiving holiday tomorrow in the US. Thanks very much. Have a great day. Thank you.